It is 3 p.m. live from our studio in New York City. I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. The S&P 500 on track to close above 5,000 for the first time ever. We are taking a close look at the market and the market milestone, and we'll give you insight into whether you should take some money off the table or double down.
And tech stocks once again leading the way today, and there's some reshuffling among the largest tech names, and there's a new leader breaking down the numbers and who's at the top of the list.
Plus, a new installment of Goodbye or Goodbye. Today we're looking at the travel sector, where not all names are created equal despite strong consumer demand to get away. What you need to know for your portfolio ahead. Let's get you up to speed on the market action on this 5,000 day. I don't have a hat. You don't have a hat. Maybe Jared Blickery has a hat. I don't know. That's just something that maybe sometimes some of the traders on the floor will do. They'll have usually it's Dow in multiples of 1,000 hats. In any case, if you take a look at the major averages here, we are pushing higher today with this 5,000 level in sight and even having been surpassed. So unless, this is, a caveat, unless something changes dramatically in the next hour, we're going to close above 5,000. This, even though the Dow is lower today, off by about 51 points right now, coming down from its record close yesterday. The Nasdaq up 1.2% today, showing once again the persistent strength of tech, which, by the way, is the leading group in the S&P 500 again today.
Yeah, so we are, as you noted, Julie, we're about to make some history here, potentially. S&P 500 on pace here for the first close above 5,000. Big milestone, big round number. By the way, interesting stat I also saw from Barron's. We are on pace to close higher for the 14th week out of the last 15. That hasn't happened since 1972. So bulls, they are in charge. They're feeling good. You could argue why not. Economy's growing. The Fed's expected to cut rates. Solid earnings season. Of course, we should mention, we have spoken to some very smart strategists this week, some market professionals who say, it's just like this kind of market. Just when everything seems really good, it's all dancing bears and rainbows. That's when they get a bit cautious, at least in the near term.
By the way, I like a market milestone that hasn't happened since before we were both born. That's always a good one. I like to hear that. Some of the other stats that I found was interesting is how rapidly we have gotten here, and those numbers coming from Bloomberg here. 719 sessions is how long it took to get from 4,000 to 5,000, and that's a much shorter time period than it was to get from previous 1,000 point jumps. Obviously, on a percentage level, it gets a little bit easier, but on a point level, it's interesting that we've seen it compress as well to that degree. And I was just looking at some of the groups that have led us from 4 to 5,000. Surprisingly, energy is the best performing group in that period of time, and that's going back, by the way, to April 1st of 2021, I believe. Energy, the best performing group. Tech, the second best performing group. Not surprisingly, real estate and utilities have been under pressure in that time because we've been in a rising interest rate regime.
Yeah. Interesting, too, we talk about big tech.
Yes.
Magnificent Seven, dynamic duo. You know the new one I just heard?
Tell me.
I kind of like it. The 3 AI amigos.
AI
That courtesy
amigos.
of longtime tech investor Gene Munster. Our viewers know Gene, very well known, well-respected tech analyst. He's talking specifically Apple, Alphabet, and Meta. Because I think people right now, we look at Magnificent Seven, there's your kind of nice graphic right there. They're kind of thinking, well, where do I place my bets now? Munster was saying those three names, Apple, Alphabet, Meta, he thinks have the biggest potential upside relative to expectations.
Fantastic movie, for what it's worth, for those who've not seen it.
Underrated, frankly.
As a moniker for these three stocks, I'm not yet convinced. It feels a little early, but we'll see.
Yeah, he has to work on it
Please
a
let him
little
know.
bit. Yeah.
No, but I think it's interesting, too, the neck and neck now market cap race we are seeing between Amazon and NVIDIA in particular. We were just showing them. They're both at 1.8 trillion market cap if you round. But NVIDIA is still a little bit lower. It's something like 1.78, but we rounded up a little bit. But still seeing Microsoft is the largest by market cap. Tesla, as has been much discussed, has fallen pretty far from where it was. And there's some discussion about whether it belongs in the Magnificent Seven at all. But again, the emphasis here is that they have contributed so much to the gains that we have seen. And in many cases, their price to earnings multiples on a forward basis, whether you're talking about an Alphabet or an NVIDIA, is still not according to some investors at least, at extreme levels.
Yeah. NVIDIA is such a fun one to talk about. We're still waiting for those earnings, by the way. And remember we talked to chip analyst Stacey Rasgon, said it's still cheap.
Exactly.
Valuation's
He's
still
one
attractive.
of those people who said that. All right, let's run now and talk more about the latest market moves as we count down to what may be another historic close. We want to welcome in Ben Kirby, Thornburg Investment Management co-head of investments. Ben, thank you so much for being here. I want to start with this big round number that we're looking at in 5,000. How do you think about these numbers? How important are they when it comes to strategy, but also to investor sentiment?
Hi, thanks for having me. Look, I think it's more important to sentiment than it is to reality. It's a big round number, but what probably matters a lot more is valuations and earnings growth and sustainability of that earnings growth. So I think we're a lot more focused on that. And on that front, stocks are relatively extended, perhaps not extreme, but getting relatively more extended this year and increasingly last year as well.
So Ben, it sounds like when you look at this rally, you're seeing some red flags here then?
Yeah, so the big round number is the market cap weighted S&P. The equal weighted is nowhere near an all-time high. And that's interesting. So the Magnificent Seven is maybe narrowing. Maybe it's the Magnificent Four at this point, right? I think Tesla's maybe not in there. Google hasn't been great this year, Apple hasn't been great this year. So the market leadership has gotten more and more narrow. But if you take a bearish view, maybe that's a bearish signal. On the other hand, again, the equal weighted, there's still a lot of interesting rocks turnover out there, interesting valuations.
And even in that narrowing, the market keeps making new highs, Ben. So at least thus far, maybe it's a forward signal, but thus far it has not proved to be an obstacle. But where is that next leg of growth going to come from, if indeed you do think it's going to come? And we've been coming off a strong earnings season, but now we're going to be going into a lull period where there are not as many companies reporting.
It has been a pretty good earnings season. So if you want to look at earnings, they were actually negative in the previous 3 quarters. And then finally in the fourth quarter, we had positive earnings on a year-on-year basis for the quarter. And more companies beat expectations and revised up forward growth. So that's a bullish sign. It's fairly broad-based in terms of the sectors that have been outperforming from an earnings standpoint. So as fundamental investors, we really look a lot at that. We want to see it, how our companies are progressing on a fundamental basis. So again, fourth quarter looks pretty interesting. I think the other big topic is really the Fed and interest rates. And I think the Fed should maybe get a Nobel Prize for the way they've managed the interest rates moves and the inflation move over the last couple of years. They've caught a lot of flack, but actually here we are. Inflation has come down a lot, and the Fed could cut rates or they could choose not to cut rates. They actually have the flexibility right now, which is really powerful.
And Ben, it sounds like given the high marks there, you're going to get a Jay Powell. It sounds like, are you in the camp then, Ben? You think, though it's rare and tricky, he's engineered the soft landing?
It's rare and tricky. It seems like at the moment, again, inflation continues to come down. The job market remains strong. Wages continue to go up. Growth is positive again. Look, there were a lot of naysayers all of last year. Every quarter we're going to a recession. As recently as last fourth quarter, there were famous pundits saying we may already be in recession right now as of last fourth quarter. And they were dead wrong. What actually happened was growth was accelerating, not decelerating in the fourth quarter. So I think there's some cause for humility from some of the market participants who have been speaking against the Fed. Actually, we're in a pretty good slot. We could still have a recession. I don't think we can rule that out. But at the moment, it looks like the soft landing is a lot more likely.
Ben, all of that said, you actually are looking at international stocks to provide some opportunity right now. Why is that?
It has a lot to do with valuation. So valuation is interesting. On a next 12-month perspective, valuation really doesn't matter that much. But on a 3, 5, 10-year perspective, the starting valuation for risk assets is a huge driver of your forward returns. So where the S&P is trading at 21 times earnings, you can look at Europe, Japan, emerging markets. They're all at significant discounts, call it 20 to 30%, even more in some cases. And that discount is wider than it normally is. So as the U.S. market keeps powering forward, a lot of strength in the economy, but let's look outside the U.S. for some diversification and some lower valuations, which probably argue for higher future returns.
And Ben, I'll get you out of there on this. When you look overseas, when you look internationally for opportunity, would you include China there?
China's a bit of a special case. Yes, international opportunity there. China has some challenge with the property market. They have an increasingly authoritarian government, which seems to be clamping down on a lot of private enterprise. So as a capitalist, I really want to see my companies have good governance, and I want to see them be able to grow and not have those economics taken away from them by the government, as is happening in China in many sectors. So China's one I think you have to be very careful and selective whenever you go into the market. But again, Europe is kind of getting off its back after some pretty slow growth. Japan looks pretty strong. And other parts of emerging markets have a lot going for them as well, given where they are in the rate cycle and the growth cycle also.
All right, Ben, thank you so much for helping us kick off the show today. Really appreciate your time and insight.
Thank you.
Let's check in on some of today's top trending tickers. We're going to start with New York Community Bancorp in the news again. This time shares are higher after its chief executive officer, along with some other insiders, bought more than 200,000 shares of the stock. So NYCB, Julie, stock gained some ground today. Execs maybe showing some confidence, of course, in the bank. CEO, some other insiders, they buy more than 200,000 shares. The purchases amount to an estimated $860,000. Of course, the stock's been, we know, shelled since last week when the bank surprised investors with, larger loan loss provisions and, of course, that dividend cut.
Yeah, and one of the people buying shares was the chairman, the newly appointed chairman, Alessandro Danello, who bought about $200,000 worth of the company stock, according to the Journal, which is about 50,000 shares. So what does this do when they make these big sorts of purchases? Well, it's meant to send a signal to outsiders that there is confidence, internal confidence, that this company is going to recover. Yeah. They have skin in the game. Yeah. All of that said, the stock is still down more than 50% this month alone on all of these concerns. So, will this be enough to stem the tide? Yeah. One day, it's going to have to last more than one day if that is the case.
It's interesting. You saw sort of investors, we were talking about this week, they were kind of initially sniffing out who else among the regional banks. But now it seems like the consensus perspective seems to be, NYCB's problems are its own, idiosyncratic.
Yes, we shall see if that ends up being the case. Let's talk about Moderna. Those shares are slipping today after the company presented stats for its experimental RSV shot that was worse than previous data. This has Wall Street analysts concerned over faster declines in the efficacy of this vaccine when compared with rival shots from Pfizer and GSK. The shares are down some 7%. RSV is that virus that is particularly harmful for the elderly, for example, for infants. There's been some concern over the spreading of it. And indeed, these results seem to show that the further out you get from the shot, the less effective it ends up being at protecting against RSV, although it isn't clear why that happened. And it looks like people are still trying to sift through this data.
The other headlines I was seeing today with this one, this kind of patent fight they're having with Arbutus, which is really interesting too. And I guess it sounds like it's kind of concerning technology used in its COVID-19 vaccine. That was also getting some real interest, and analysts were kind of trying to put some numbers around that. For example, analysts at Bloomberg, Julie, said they think Moderna actually faces an uphill battle to avoid liability in that patent feud. So I know that was another headline making some news. Moderna, I'm just looking at the stock, down about 10% this year, down about 45% now over the past 12 months.
Really, yes. Investors are looking for more stuff from Moderna, right? More things coming to market and more revenue, which the company has said is coming.
Finally, let's get to shares of Pepsi here, fizzling. Oh, nice. Get that, fizzling? This afternoon, as it posted mixed results for the fourth quarter, missing on those revenue numbers. CEO saying that U.S. sales broadly slowed down in the fourth quarter, so you're down more than 3% here. So snacks and soft drinks, Pepsi reports investors disappointed. Earnings beat relative to expectations. Revenue was light, it looks like. The forecast, not great either, Julie.
Yeah, the culprit seems to be Pepsi raised prices too much. Yeah. Raised them too much, too fast, for too broad an array of products. And now the company is saying it's going to be not doing that as much. But that seems to be really a big issue here for Pepsi. We were asking for so long, when are customers going to push back against price increases across a broad array of products? Pepsi has given us one answer here. One other minor thing or other detail here, analysts pointing to weakness in Quaker Foods in particular as a reason for disappointment. So that's something else that bears watching.
Yeah, by my sales growth should be at least 4%, they're saying, on an organic basis in 2024. That was not good enough. The street wanted to see closer to 5%. By the way, Coca-Cola reports next week, so we'll see what they have
we'll
said.
see if this is a harbinger for Coca-Cola. We're just getting started here on Yahoo Finance Live. Coming up, President Biden's age back to center stage in the 2024 race. That's after the special counsel report and a flub during a news conference last night. Plus, Bitcoin surging today, now sitting above $47,000. We'll break down the latest crypto moves later in the hour. And the newest edition of our series, Goodbye or Goodbye. We'll get analyst insight to break down 2 stocks and help you make the best choices for your portfolio. We'll be right back. What should have been a win for President Biden turned into a bit of a mess yesterday. A special counsel report finding that Biden would not be charged even though he willfully retained classified materials. But it's the reason why that is sparking controversy. The report describing Biden as an elderly man, that's a quote, with a poor memory, questioning his mental fitness and ability to recall key moments of his political career. Biden responding in a news conference last night.
I'm well-meaning, and I'm an elderly man, and I know what the hell I'm doing. I've been president. I put this country back on its feet.
Mr. President, for months when you were asked about your age, you would respond with the words, "Watch me." Many American people have been watching, and they have expressed concerns about your age.
That is your judgment. That is your judgment. That is not the judgment of the press.
And then the president going on to make a blunder when talking about the conflict in the Middle East, mistaking the president of Egypt with Mexico.
As you know, initially, the president of Mexico, Sisi, did not want to open up the gate to allow humanitarian material to get in. I talked to him. I convinced him to open the gate.
So what to make of all of this? Rick Newman is with us with this week's Bidenomics. And I think, particularly as we try to tie it back to the markets and the economy, Rick, how should we be viewing these last, 24 hours?
Right. I mean, you wouldn't think Biden's age is an economic issue, but I think it's turning out to be one because it really is becoming one of the biggest issues in this whole campaign. So Biden was really not correct when he said that concerns about his age are just a matter for the press. The public is very concerned. I mean, polls have been showing this consistently. So this gets to the whole question of whether Biden's age, he's 81 and would be 82 when he takes office in a second term, if this will actually become something big enough that it could actually prevent him from getting reelected. And that does have direct implications for markets. It has implications for trade policy. I mean, remember, Donald Trump, assuming Donald Trump is the competitor, wants a 60% tariff on all Chinese imports. The last set of tariffs weren't enough. He wants even more. He would cut taxes. Biden would raise taxes. And there are many other significant differences between these two candidates. So, I mean, I don't normally cover, the age of the president or geriatric issues for Yahoo Finance. But I mean, look, this is now right out in front of everybody. And I think if there's any way to turn this into a positive for Biden, it's that this prosecutor, by raising these issues, I mean, he made it painfully clear to Biden and his team, Biden needs to confront concerns about his age directly. He can no longer just say, "Watch me," and then shuffle off and assume that if he signs a piece of legislation or something, people are not going to worry about his age. They are worried about his age, and he needs to deal with it.
What would that actually look like, though, Rick? What does deal with it mean?
It's a great question. I mean, does he join a Jack LaLanne program or something like that? I don't know. I mean, I mean, the reporting out of the Biden campaign and from the White House is that, the number one thing is just to try to prevent any kind of mistakes or slip ups. For example, he now wears dress sneakers instead of loafers so that there's less chance that he's going to slip or stumble like that. I don't know. But Biden has to be out there in front of people. I mean, as an example, the White House decided not to do this interview, with CBS before the Super Bowl. And I think you can speculate a couple things at this point. Number one, maybe they knew that this prosecutor's report was coming out this week and that would probably dominate the conversation. But maybe they're just afraid to put him in front of a national audience. And if they are, I mean, if Biden is becoming so frail that he really should not be speaking off the cuff in front of a national audience, maybe he's just not the guy to be running for the Democrats.
Well,
I mean,
if I may, Rick, he didn't come across as frail necessarily, right? I mean, I don't know. I don't know how we characterize that.
So it's a fair point. So at the end of that short press conference yesterday, he walked away and somebody asked him a question about what's happening in the Middle East with Israel and with Hamas in Gaza. And he actually gave a coherent and thoughtful answer that, to my ears, indicated he knows exactly what's going on in that situation. There are some things he said I'm not going to get into, but he's engaged. It's pretty clear that he's doing it. He's doing the policy. He's not just sleeping all day and letting his aides do it. And then that's when he messed up who's the leader of Egypt. He mixed up Egypt and Mexico. So he got the leader's name right, Sisi, it's Egypt, but he just said it's Mexico instead of Egypt. I really don't know. This is a tough problem. And, we really have not had to confront this in this manner in politics. I mean, Reagan was supposedly losing it a little bit at the end of his second term, but that was the end of his second term. He wasn't running for re-election. So Biden has a new problem and he's got to solve it.
Yep. Big story, new chapter. Rick, thank you so much and have a great weekend.
Bye, guys. You too.
Well, joining us now for more on this situation is Raymond James Washington policy analyst and managing director Ed Mills. Ed, it is great to have you on the show. And maybe, Ed, just start here with your reaction, Ed, to Special Counsel Robert Hur's report and also Biden's presser last night. What did you make of it?
So, Josh, I do think that this is going to be a close election. And, we will be looking back probably in hindsight to make a determination. How much did this event, how much did other events this week, we've had a number of things related to President Trump, ultimately influence the election. But what I've been focused on here at Raymond James is kind of what was Rick talking about, some of the outcomes here. And there are huge policy decisions which will have major market reactions, taxes, regulation, geopolitical events. So when I get questions at Raymond James, yes, we are debating about how much this impacts the election. Is President Biden and former President Trump on the ballot come November? There seems to be a nagging sense that there's some unknown things that could happen this year that could have an outsized impact. But I don't think I can really predict that. So I'm focused on, if there is a Republican president, what are those policies? If there's a Democratic president, what are those policies? Because even as we shift out some of these players, there's not as big of a change as I would necessarily expect, given where kind of the makeup of Congress could be, especially.
Right. That is a great point. It's not just about the president, right? It's about Congress as well. And as we see right now, Congress is not getting anything done because they can't come to agreement, Ed. So how do you sort of put all of that together and figure out what the different outcomes are going to look like in terms of economic and trade policy come, after the election?
Yeah, Julie. So I'd start with before the election, we still have not yet figured out how we are going to fund the government after the end of this month. But what we have been telling folks at Raymond James is that when you look at what they've agreed on, where the dollar amount's going to end up, we are debating a defense supplemental in the Senate. That could add another $95 billion of fiscal spend here. There's an $80 billion tax bill that seems like there's an opportunity to get that done in the Senate. It's already overwhelmingly passed the House. So when you're adding these things up, at the beginning of the year, lots of questions about whether or not there was going to be a fiscal drag. But now we're going to see kind of further fiscal support. After the election, the biggest issue really comes down to we're coming into the debt limit. We're coming into the expiration of the tax cuts that passed under President Trump in 2017. There's an expectation that if it's an all-Republican government, those get extended out. Much more nuanced conversation if President Biden or there's a divided Congress in that debate there.
And just getting back to Biden here for a second, I do want your opinion on this. Given what we heard yesterday, what we saw, you had Special Counsel Robert Hur saying that listen, Biden could not remember when he was vice president of the United States. Are you fielding questions from your clients about whether Biden even remains in this race or whether he steps aside? Are they asking you that? And in response, what are you telling them?
So, Josh, I mean, that's been one of the biggest questions. There's a sense that, this election is going to be a repeat of 2020, and that might be inevitable. But in D.C., things are impossible right up until they are inevitable. And so, yes, throughout this whole process, last year, a lot of it was it's not going to be Trump as the nominee, and now it's kind of overwhelmingly a sense that it's going to be him. There is a awful lot of questions from clients on whether or not it's going to be Biden. The answer is no one knows. What he said last night was that he feels he's the most qualified person for this position. He sounded like someone that was adamant about getting the nomination. We look at the votes. There has been a challenge by Dean Phillips in New Hampshire, kind of write-in won overwhelmingly for Joe Biden. In South Carolina, Dean Phillips barely broke 4 digits, and Biden had a 90+% poll. So it's like, there's these questions that are coming in, but when we look at the votes, the voters have not yet showed us there is a strong desire for an alternative candidate, or at least something that they have an option on a ballot as of right now.
Ed, I don't envy you your job a lot of the time, but this year is uniquely challenging. So thank you so much for sharing your insight with us.
It's going to be interesting.
Yeah, as you try to game it out. At least you can figure out maybe policy-wise what each of the candidates would do. Thanks so much, Ed. Appreciate it.
Thank you, because that's the most important.
Exactly. Bitcoin rallying above 47,000 today. Jared Blickry here with the trade. 2 days in a row that we're talking about Bitcoin here, Jared.
How about that? How special. We got Bitcoin heading to 50,000. Not there quite yet. Got a few thousand to go. Here is the 3-month chart. I've been showing this because Bitcoin, for the most part, since the beginning of December, has been locked in a trading range, even when it broke above here. And this was that sell the news spot Bitcoin ETF moment. It was very brief, lasted only a few days, similar to this breakdown, only lasted a few days. And here we are. What I like about this chart is that price seems very comfortable around this area that was swiftly rejected before. As we head higher here, as we approach 50,000, I'm going to want to see if that price level is accepted or if it's rejected. And if it's rejected, you get one of these big tails or wicks or shadows as the terminology goes. But why this level? That's because we have price memory here from way back in 2022. If we are able to clear 50,000, guess what? This puts 55,000 in sight. So one step at a time here. And I'd also like to take the opportunity to check out some of the flows that we've seen in some of these spot Bitcoin ETFs. Been really interesting. 10 overall. I have the top 5 in terms of volume, both to the upside and the downside. What really stands out here is the Grayscale Bitcoin Trust. That has lost over $6 billion in flows. It has by far the most assets. It was founded in 2013. It still has a management fee of 1.5%, but a lot of these flows have gone to competitors. IBIT, that's iShares offering, that has $3.5 billion worth of flows, and then Fidelity, pretty close on its heels there. So we'll have to see all of this shakes out, but really going all in a lot of these issuers on these spot Bitcoin ETFs. I would mention that the iShares offering is one of the top 10 Bitcoin ETFs in terms of flows this year. That's substantial.
Jared Blickry, thank you so much. Appreciate it. And coming up, the latest edition of our series, Goodbye or Goodbye. Get analyst insight to help you make the best choices for your portfolio. Stay tuned. More Yahoo Finance after this.
There's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look at lifestyle stocks. Pent-up demand post-COVID saw consumers spend big on experiences last year. So what's the best way to play it now? I'm here with Paul Golding, Macquarie Senior U.S. Lifestyle and Payments Analyst. Thanks for being here. Good to see you in person, Paul. Usually we talk remotely. So let's talk about your Goodbye stock, first of all. It's in the cruise industry at Royal Caribbean specifically. And like many of the cruise stocks, it's done pretty well over the past year because people are cruising and there's good forward bookings as well. And you like the cruise industry, but you say this company is really the best in class. Why is that?
Well, first off, they're making good on this margin expansion promise post-COVID. They've changed the dynamics in which their ships are occupied, and that allows for better efficiency per sailing. The other piece of it is that they manage the balance sheet best through COVID, in our view, and they're deleveraging quickly. So we like them for those reasons relative to the peers, and we also like the fact that they have been very good at managing their fuel exposure and the fuel hedge portfolio. So it's a variety of things around revenue, cost, margin, just doing well in general in our view.
Yeah, and the deleveraging is interesting in particular because it's expensive to have a lot of ships, and a lot of these companies are pretty debt laden, so that's an important piece of it. Now, overall, you do like the cruise industry and sort of the value proposition that they would argue that it's sort of an all-in-one deal to take a vacation on a ship.
That's right. So pre-COVID, cruising was about a 15 to 20% discount to a land-based alternative for the same like-for-like type of trip. Coming out of the pandemic, it got as bad as 40 to a 45% discount. Royal Caribbean has been driving price and making that back, so we like them for that as well, but we still see some runway ahead for them to continue to shrink that discount based on the value that they provide, maybe excess services and luxury relative to what you would spend for a similar trip on land.
Interesting. I didn't realize the discount was so big. And then also, you're talking about new ship formats. You mentioned margin expansion. What is it about these new ship formats that makes bigger opportunities to make margin?
So as a lot of news has been generated around the launch of Icon of the Seas, this is the largest cruise ship in the world, but that also means the propulsion is more efficient. You can get more people on board propelled by sort of the same systems and the same hoteling outlay in terms of energy, but you also provide more opportunity for onboard spend because the ship has more amenities, roller coasters and water slides and various different amenities that make it so that the consumer, once on board, can find more opportunities to spend money. And so that means that the margin profile for the business could expand over time as more ships with this format are put into service. And there's another ship coming, Utopia of the Seas, this year that is a large class ship.
Yeah, I was reading a little bit more about the Icon of the Seas today. On one of the water slides in particular, there's an upcharge. Some of the restaurants, there's an upcharge. You can do quite a lot included in the price of the ship, but there's a lot of those opportunities as you talk about. We like to point out what the potential risks are to the bull case here. And in this case, it could just be if there is a macro downturn. Let's talk about that first, and then we'll get to the second point.
Sure, macro headwinds. The consumer still needs to be interested in taking a trip and spending money on leisure services and consumer discretionary spend, right? So as we think about macro headwinds, the savings post-pandemic have been strained as stimulus has run out, and we've seen other factors play on the consumer's propensity to spend, whether it be higher interest rates and maybe the delinquency data that we see coming out as a result of that. So over time, as those things compound, there is the potential for these headwinds to subdue consumers' willingness to spend on travel.
And then what is the effect of these emission standards? I mean, speaking of Icon of the Seas, for example, that is a ship that because of its size, some environmental activists have been critical of it.
That's right, and in places like Europe, they've actually instituted a new emissions tax system. It's not new, but the tax rate and the way that they levy that tax is new for sailings within Europe. And so as more jurisdictions become more stringent around emissions from cruise ships or shipping in general, we could see that pose maybe a headwind to some sailings or pose a headwind to margin. Not meaningful at the moment, but could be more meaningful over time.
Something to watch.
Yeah.
And is this a stock that you own or the firm owns?
No.
Okay, gotcha. Okay, so let's get to the stock that you were avoiding, and this is Vail Resorts. So from the seas to the mountains, we are going here with Vail. The first reason has gotten a lot of press recently, and that is there's no snow, or there's less snow, or it's difficult to predict how much snow is going to be. What effect is that having on Vail?
Yeah, so in the most recent season-to-date update for mid-23-24 ski season, we heard from the company that skier visits were down 16% year over year relative to the same period last year. So 16% decline on the basis of not being able to open some runs or some resorts on time because of weather is a significant driver of some of these risks to their business model. This also is sort of indicative of the extent to which snowmaking can't necessarily replace good weather and good snow from nature.
Yeah, that makes sense. And then also, we're talking about barriers to growth, and this has to do both with new skier acquisition, right? Because it's expensive to ski. It's difficult to learn how to ski, and then also expansion in terms of actual physical property. So talk us through both of those briefly.
Sure. Well, skiing requires skill. It can be dangerous if you're unskilled. It can be dangerous even if you're skilled.
It's true.
And skiing can also require that you purchase, rent equipment, spend money on that, travel to a resort, whether that's travel by car to a mountain or for destination resorts, which are the bread and butter of Vail. You have to fly to a mountain at a destination. And so the cost ends up becoming a barrier to growth, as well as the actual nature of the activity.
Right, and what about growth in terms of growing properties?
Yeah, well, it's been about a decade where Vail and its key competitor have been consolidating the industry, acquiring resorts in North America and driving growth that way through an organic acquisition. And so as we look at Vail lately, it's been acquiring resorts in Europe to keep the acquisition momentum going, but
right.
The North American pipeline has run a bit dry.
Limited. And we should mention, by the way, when we talk about cost of entry, I mean, an Epic Pass that sort of is all in for the Vail Resorts is more than $1,000, which I guess if you're skiing a lot, maybe is a bargain, but that's still a high price ticket. And then lastly, congestion. The resorts that are open, that do exist, are crowded.
That's right. We're neutral rated on Vail and have a $225 target price, and that sort of came into effect around the time that the company was introducing Epic 1-day, 2-day, 3-day passes and filling in the gap between a window pass and the unlimited pass. And what that's done is it's created congestion on the mountains that's been noted in the press quite frequently in the prior season. The company said that they're looking to make improvements this season, but as pass penetration continues to rise, it creates the potential for more congestion, and that decreases the guest experience relative to what is an otherwise high price point leisure activity.
Right. And then finally, the risk to this down case. In other words, what could go right? Well, just that, core affluent customers can be resilient. We've seen that so far.
That's right, and this is a relative risk, right? Relative business case in terms of the investment holding better than other investments in the leisure space. The affluent consumer is the bread and butter of Vail's customer base in terms of being able to get people to the mountain and spending the money that it takes to ski. And so in a downturn, they tend to be more resilient than a middle to lower end consumer who may see more strain if macro conditions tighten.
Right. At the same time, if the mountain's too crowded, maybe they'll take a different kind of vacation entirely or go to Europe. Who knows? All right, let's summarize the case that you've made for investors here. You're telling them, buy Royal Caribbean Group. You view the company as best in class in the cruise industry, and new ship formats could enable more margin expansion. On the other side, you say avoid Vail Resorts based on the volatility we've seen in weather, barriers to new skier growth, and congestion affecting the guest experience. Thanks so much. Really appreciate it, Paul Golding.
Thanks for having me.
And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern. We'll be right back. Disney is going all in with streaming sports. The media giant announcing this week 2 power moves with its ESPN segment that may spell trouble for the cable bundle. Here with the details, Yahoo Finance's Alexandra Canal. So how should we frame this and all the news that we got this week?
Well, 2 important pieces of news. One, the ESPN over-the-top streaming service that is going to be coming sometime in fall 2025. Separately, ESPN is also teaming up with Warner Brothers Discovery and Fox for its own sports streaming combo service that is going to debut sometime this fall. But these come at a very critical time for Disney, which, like many other companies within the world of media, are struggling with when it comes to consumers' pivot to streaming from linear TV. Now, a big part of this conversation has been if you look back in the past, a lot of these companies have relied on affiliate fees and advertising in order to drive their business. But now with streaming, that's sort of out the window. We've seen linear television essentially fall off the cliff. Linear networks revenue in that segment fell 12% year over year for Disney. We've also seen some serious advertising declines. But at the same time, linear is bringing in the profits. It's still a profitable segment for Disney. Streaming, unprofitable. Losses continue to narrow. So it's this double-edged sword for Disney. And I was digging through some of these earnings, the conversations that analysts were having following Disney's results. And one stood out to me. This is from Morningstar analyst Matthew Dolgan. He said that pricing is going to be a big conversation because right now we don't know the prices here. The combo service, it's reportedly going to be upwards of $40 a month. We don't know what the ESPN over-the-top service is going to be. But if they're priced too low, that's going to speed up the demise of cable TV. And if it's priced too high, it's going to hinder demand there. So when we're at this critical juncture for a lot of these media companies when it comes to weighing how linear TV can offset some of the subscriber declines monetarily, I just don't know how these companies are going to get to that point, because it's sort of that chicken and egg situation where you have this is the future streaming, but you're losing money. Linear, not so much the future, but it's still profitable.
Yeah.
And now let me get your take on this headline, which we just saw crossing from the Journal, which is that Amazon's Prime Video getting to exclusively stream an NFL playoff game next season. What do you make of that and what it means for competition?
I think this points to this ESPN, Warner Brothers Discovery, Fox bundle that we saw come out earlier this week, because it's a defensive move against big tech. We've seen big tech really lean into sports more heavily. I mean, Amazon has that Thursday Night Football deal that's over an 11-year period. Google's YouTube has the rights to NFL Sunday Ticket. Apple has a deal with the MLS. So this is a way for these legacy cable operators to distribute and produce the content and not have that big tech competition. And to note, Comcast Peacock, they got an NFL playoff game this year. Now it's going to Amazon. We don't have much details around it, but again, I think it points to how sports is the last frontier of streaming. You have big tech that has the big pockets, a lot of the money that they can support. How do these other players really compete against that? They're teaming up. So I think we're going to see more of that down the line, and that could lead to consolidation in the future.
All right, we'll keep watching, Ali. Thanks so much. Appreciate it. We move on. The S&P 500 set to close above 5,000 for the first time ever, with the gains driven by big tech. But the question now, is it time to take a breather, or is there more room to run? And we've got your investor playbook with Shayna Sissel, Banrian Capital Management CEO, and Jeremy Bryan, Gradient Investments Senior Portfolio Manager. Welcome, both of you, to the show. Jeremy, I'll start with you. Listen, we could be making history here. It looks like the SPX, the S&P 500, about to close above 5,000. Jeremy, I'm just curious, you look at this run, you think that rally continues, or no, do you think maybe there's some signs of caution here, at least in near to intermediate term?
Yeah, I look at 5,000 as more of just a milestone, right? It doesn't really tell us what future direction holds at all. So from our perspective, we're still looking at the business fundamentals. And for the most part, there's still relatively strong signals out there that we could continue this. First, that, just generally markets, when they hit all-time highs, there's more of a higher likelihood of going higher than lower. So you have history somewhat on your side. We just cleared an earnings season for the most part that was, had some mixed bags, but I think overall generally didn't change the trajectory negatively. It probably was equal to maybe even slightly positive. And the jobs numbers continue to be very resilient. And that's been the biggest part from our side, is understanding that a consumer that has money and has job, or can get a job if they need one, is going to continue to spend money. That's what drives our economy. That's why we maintain relatively positive on the market overall.
And Shana, what about you here? The momentum that we have seen that has carried us sort of past this 5,000 level and keeps hitting new records, what would be sort of the most likely contender to stop it if it was going to stop?
Well, I don't really see a lot of headwinds for what's going on. We have very strong economic growth, very strong employment. But if there was anything, it would be the Fed. I think that most likely the thing that could put the brakes on what we're seeing is the Fed not cutting rates the way the market thinks. They've been very clear that they do intend to cut rates this year. They're not really sure how many times. The market expected 6. The Fed put a kibosh on that. I think if anything is going to be the thing that puts the brakes on what we're seeing, it's going to be Fed action.
And Jeremy, I'll come back to you. Come back to just some investment ideas for our viewers. Jeremy, I know one sector you like is healthcare. How come, Jeremy, and where exactly do you see opportunity there?
Yeah, relatively discounted valuations and still pretty good top line and earnings growth. I mean, there's certain areas, healthcare really didn't work that well last year. I mean, if you look overall, comparatively, it was an underperformer. Obviously, most was underperforming against tech. But even in that case, there were a couple of standout performers via the GLP-1 drugs, but everything else was kind of middle of the road. Again, they became cheaper as a result of that because their earnings estimates didn't come down a heck of a lot. So that's where we think that there's just opportunity, whether that's in insurance and devices. Those are the kinds of areas we're concentrating most on. We just think they're opportunistic and the valuations aren't aggressive for the opportunities they have.
And Jeremy, though, would you stick with the GLP-1 producers, Novo, Lilly?
No, that's their short answer here. So the quick answer of that is, we still think it's a phenomenal opportunity, right? Don't get me wrong. There's still going to be an addressable market that's massively, but the valuations that have come as a result of that, it's a very different story than NVIDIA, right? That's another massive story. But if you look at the earnings growth there, that company's valuation's actually been about the same to even slightly cheaper. That is not the case for Novo and Lilly, who have had dramatic changes in their valuation profile. That's just going to make them, if you have a 3 and 5 year time horizon, especially as competitors come into the play, it's just going to be a little harder for them to kind of continue to accelerate at that pace, unless we believe this opportunity is significantly bigger than even numbers are anticipating right now. And we're just not there. So we chose to eliminate. We've had those positions in the past. We don't have them any longer.
And Shada, let's kind of get your investor playbook here as we look at these highs in the market. I find it interesting as we talk about healthcare and looking beyond the GLP-1s that Novartis is on your list of picks as well. Are you sort of thinking similarly to Jeremy here when it comes to healthcare and sort of non-GLP-1 healthcare?
Very much so. Veritex Pharmaceuticals and Novartis are the 2 healthcare names on our playbook list. Both of them have really, really strong franchises in certain areas of the market, which I think have growth opportunity. With Veritex, it's the cystic fibrosis work that they have. They basically own that market, and they're growing out other areas. In the case of Novartis, they have some real game-changing oncology drugs like Kisqali, which has changed the game when it comes to breast cancer. These are drugs that have great growth potential. These particular firms have great franchises and a great moat around those franchises that really put them in control. So I'm looking away from the Eli Lilly's and really focusing on these other places, which could be the next big drug deals that we start to see coming through that really are changing the game, broadly speaking, as well. And those are the 2 that I really think have that.
And Jeremy, I also want to get your take on the Magnificent Seven. Of course, listen, a lot of viewers listening right now, they're in those names, Jeremy. They've had strong runs. Do you see, big potential upside relative to expectations for any of those names?
Yeah, we still own 6 of the 7. The one that we've never owned Tesla. Just frankly, it's a little, we don't quite understand the story quite as well. But from our point of view and our perspective, Amazon and Google still seem to be the best relative long-term opportunity. But what we've been doing across this board is, as these continue to accelerate, and especially when they have these dramatic runs, is we've just been taking some off the table without selling them entirely. And I think that's absolutely prudent and justifiable to do, is that you don't have to sell the position out entirely, but probably bring that back because the concentration in your own portfolios has probably gotten pretty high if you've owned these throughout this entire time. So taking those profits and taking some of that off the table and still owning them if they continue to rally, but using some of those profits to buy other things that haven't participated quite to the certain extent is absolutely prudent, and that's what we've been doing here.
And Shana, I know you own NVIDIA too, but we got to leave it there because we're coming up on the closing bell. So we'll have you both back soon. Shana and Jeremy, thank you so much. And indeed, it almost is time for the closing bell on Wall Street. As we look at the three major averages, the S&P 500 is still holding above 5,000. In fact, it's even built on the gains a little bit over the past hour. So we're looking at 5,026 at the moment, a gain of more than 0.5%. The Nasdaq, as we've been talking about, really showing strength here. The Nasdaq 100 at another record close today, as well as we see history being made. Josh Lipton, you were pretty excited about that. 5,000 here for the S&P 500. It took only 719 sessions to get from 4 to 5,000 for the S&P 500, and closing here at 5,026.52. Technology stocks, consumer discretionary, communication services helping lead the gains here today, i.e., once again, Mag 7 is at least, and large cap tech, at least a part of the story.
You know, it's a big headline, and it's not just a big round number. You do, and we were talking about this earlier in the show, you do wonder, does that provide a boost to sentiment in some ways? Do people feel like they're gonna see that headline, they wake up tomorrow morning, pick up the paper from the driveway, if people still do that, and you know, does that kind of feed a fear of missing out kind of mentality?
Well, and it's interesting because as we talked to Ben Kirby from Thornburg at the top of the show, and he said fundamentally, you know, this doesn't necessarily make a difference. And you always sort of hear that. Not always. You frequently hear that from sort of institutional investors. But to your point, I think retail investors, people with money in their 401ks who see these types of headlines, it does inform their investment decisions, or at least conversations they're having with their brokers.
How impact sentiments, for sure to watch. Another day of records on Wall Street. The S&P 500 closing above 5,000. Jared Blicker is here with a look at this historic day on Wall Street. Jared.
Thank you, Josh. We did it. We broke 5,000 to the upside and change. And let's take a look at the entire week. Up 1.37%. Final closing price 5,026 and a little change there. Dow also in the green for the week, but not today. A little bit in the red over these 5 days, just barely in the green. Going to call that basically break even. And the Nasdaq 2.31%. Also, I'd note the Russell 2000 was outperforming today. That's up 1.64%. Now, a look at the sector action today. Tech was in the forefront, along with consumer discretionary, both of those outperforming. Let's check in on the 5-day. Well, tech and consumer discretionary, both outperforming, the only ones. Now, this week we saw utilities and staples take a little bit of a backseat. Those are defensive sectors, also interest rate sensitive sectors. So that's just fine. Communication services, we did see a little bit of a rewind in Meta here after that blockbuster $200 billion day. It's down 1.4% this week. I think the investors will be just fine. NVIDIA, another record high, up 9%. Amazon, Microsoft, Alphabet, Apple, all posting some respectable gains. I'll throw Tesla in there, and Broadcom as well, which is competing for its space as the 10th largest U.S. stock. And just let that sink in for a second there. When we take a look at the leaders this week, Bitcoin, thanks to a big rally over the last 24 hours, Bitcoin is about number one, followed by solar energy. You see ARK there, disruption stocks doing well, chip stocks, IPOs, Chinese stocks. China came back this week in a big way, and momentum. So as far as the losers go, we got cannabis and high-grade bonds and regional banks. Didn't have time to get into that, but regional banks taking another tumble this week.
Yes, interesting, even as we see the rally overall. Thanks so much, Jared. Well, all told, the global economy managed to defy expectations of a sharp slowdown in the last year. Markets celebrated the unexpected momentum, driving the S&P 500 to close above 5,000 for the first time ever today. But our next guest warns there are still some lingering concerns. We're joined by Nathan Sheets, Citi Chief Global Economist. Nathan, thank you so much. Really good to see you, and thanks for joining us. So as we look at the potential risks that remain in the economy, and this is something you wrote about for Barron's recently, it seems like monetary policy is still sort of tops on the list in terms of the tightening that's happened and the effect it could still have. So what are you watching to see signs of that?
Yeah, central banks have been very vigorous over the last year or two in terms of their rate hikes. And, I think it has slowed the global economy, but not nearly to the extent that we expected. My sense is that there's still some of the headwinds associated with that tightening that are in play. And some of the key issues I'm watching is to what extent do banks continue to restrict credit to households and firms? We've certainly seen some of that. And then if firms can't get that credit or households can't get as much credit, what does that mean for spending and investment in the economy more broadly? I think we're also thinking hard about the so-called tightening of financial conditions that has come along with these higher rates. And on the one hand, you can say financial conditions are tighter because the 10-year Treasury yield is now over 4%. It's much higher than it was 2 years ago when the Fed started hiking. On the other hand, as you were highlighting, equity markets are now over 5,000. And it really is extraordinary, the resilience of the equity market in the face of these rate hikes. And I think that's another key question for the Fed and the economy, that with the equity market this strong, that means people's balance sheets are stronger. And the so-called, what economists term wealth effects that support consumption remain in play. So there are a lot of different channels, and we're watching them. So far, there's been some restraint, but not nearly to the extent that we expected.
Nathan, there are some economists, I want to get your take on this, they have kind of an optimistic view, and they say, listen, global economic growth will improve this year, and in part, foundationally, they're making that argument, Nathan, because they're looking at central bankers. They're looking at policymakers all around the world, Fed, ECB, People's Bank of China, and they say, listen, they're all going to likely ease monetary policies this year as inflation cools, so they stay optimistic. What's your take on that?
I think it's true that central banks most likely are going to be reducing the amount of monetary policy restraint, but that is contingent on what you also mentioned, ongoing and further progress with inflation. And I think that's really the key question in my mind, is what is the, and again, economists would call it the last mile of getting inflation back down to 2%. So far, it's been pretty smooth, and the Fed has made a lot of progress. But now we're struggling with a different kind of inflation. It's more about the tight labor market, high wage growth, and rapid services inflation. And how rapidly does that come off? And then that in turn is going to determine how rapidly central banks are cutting. But if central banks, as you suggest, are bound and determined to avoid recession, they certainly have the tools to ensure that there is no recession by cutting rates.
Nathan, one of the other risks that we've been watching unfold, especially acutely over the past year, is geopolitical challenges and conflicts around the globe, which are not only particularly difficult to predict, but the outcome and effect on the economies and markets around the world is particularly difficult to predict. We were talking earlier in the show about another big geopolitical event, the presidential election here in the U.S., and obviously that's another one that's very difficult to predict. So how are you incorporating that into your models, if at all?
The way we're thinking about the geopolitical environment, which, as you suggest, we've got Russia, Ukraine that's grinding on, uncertainties and stresses and tensions in the Middle East, and literally dozens of national elections around the world, including in the United States. We see all of that as a source of uncertainty. I'm not sure that I would say our global growth forecast is lower as a result of that uncertainty. But these are issues that we're watching very closely. Now, a specific area that we're watching is an implication of what we've seen so far in the Middle East and the disruptions to shipping that have resulted from those tensions. We've seen a significant increase in shipping costs and challenges there. And so it is possible that we would see further challenges to supply chains and shipping costs, which could put pressure on inflation. And that is an area that we're particularly concerned about right now.
Nathan, it was great having you on the show today and just helping us think through all these dynamics. Appreciate it. Have a great weekend.
Thank you.
Stay tuned. More Yahoo Finance coming up on the other side. Super Bowl Sunday is upon us, and the American Gaming Association is estimating nearly 70 million Americans will bet on this game. Helping us break down the numbers is Patrick Risch, Washington University in St. Louis Sports Business Program Director. Patrick, it is great to see you, and I want to start here. Bottom line, Patrick, I'm curious how much you think is actually going to be wagered on this game, Patrick. I would assume you're going to see a pretty serious, uptick in volume, Patrick, just given how many more states are legalizing betting, but I want to get your take.
Well, it's not only a combination of more states that are legalized, but also just a greater degree of comfortability, right? Now that we're now 6 years removed from the 2018 PASPA, where that was abolished, and states obviously could go ahead and legalize gambling on their own. Last year's Super Bowl, the estimate was $16 billion. The American Gaming Association, their survey just came out. They're estimating, I think it's $23.1 billion, and roughly 68 million people in this country betting on that game. So it'll be interesting to see how it breaks out. And what I'm going to be curious to see is obviously one of the big side stories of this Super Bowl is the whole Taylor Swift factor. And, you know, we not to stereotype, but the Swifties, who are mostly largely a younger female demographic who may not be as interested in football or gambling, could that particular demographic, at least on the ratings side, people watching this, could lead to an all-time record?
And you actually went where I wanted to go, Patrick, because we got to talk about Taylor Swift. So listen, as a guy who thinks a lot about sports and sports business, have you ever seen a phenomenon like this, Patrick, honestly? And is there any possible way to quantify the impact Taylor Swift has actually had on the NFL this season?
The only thing that comes close, and maybe he actually outscores Taylor Swift, that's hard to imagine, but the impact that Lionel Messi had on Major League Soccer, which was all the talk last year in at least in Major League Soccer and in North America, is when he came to Major League Soccer, the impact on the entire brand of Major League Soccer just elevated to a different level. Obviously, one of the most popular soccer players in the world. So now you juxtapose that with, if not the most famous entertainer in the world, Taylor Swift, and that impact on just the visibility. People are talking about the sport more. And again, is it bringing in ultimately what the NFL cares about? Is it bringing in a new audience? And can you retain that audience? And I think that would be really exciting if they can bring in that new audience of younger, specifically female fans to the sport of football.
For sure. And Patrick, getting back to betting as well really quickly, the more betting you see, Patrick, does that mean the more people watching the game? Is there kind of a direct relationship here between betting and eyeballs?
Well, absolutely. And this is the reason why so many states have tried to legalize and why the leagues have very much been supportive, and quite frankly, they lobby. Here in Missouri, we've got all the professional sports teams lobbying the state of Missouri, who has not legalized gambling just yet, because they realize the impact that it has on engagement. When you've got stake in the game, i.e. when you've bet on something, you're much more likely to watch, whether it's on TV or go in person. And this is changing all aspects of the sports industry, including even how you're designing your venues. Now, a lot of these venues in the states where it's been legalized, you're creating these sports book lounges within the venue just because you want to give that extra little experience for people to come off the sofa down to the venue.
And Patrick, I also want to ask you about this new streaming service coming from Disney and Fox and Warner Brothers. I'm interested, Patrick, what kind of impact do you think that could have on the cost of media rights? You know, if there's fewer bidders, could that mean the cost of media rights go down here?
You know, I don't think so. And the reason I say that, well, first of all, I think that this is a very innovative deal, and it will be fascinating to see what they're going to charge. And they say that, you know, with ESPN, Fox, Warner Brothers, there could be as many as 15 different linear network offerings that are going to be offered on the streaming app. So in one way, you're bringing everything together. But we all know that from all these other streaming devices, and I'm a subscriber to MLS Season Pass with Apple, you're going to have to pay a price. And I'm hearing on the street that this could be as expensive as $40 a month for people to subscribe to this. I think it's absolutely fascinating. And then on top of that, remember, ESPN is coming out with their own singular app in 2025, offering even more to those customers. So I wonder if we're going to end up back to the future where there's so many different things and bundles for people to buy, they end up just going back to their old traditional cable package. I don't think we're going to go there, but it makes you wonder.
Patrick, it was great to have you on the show today. Have a great weekend and enjoy the game.
You too.
Coming up, what to watch tomorrow, we break down the stories you need to know to start your day.
Hermes, Tapestry, Ralph Lauren, all out with earnings this week, painting a positive picture for the luxury sector. All of them seeing a boost in revenue, seeing the pandemic in the rearview mirror and China boosting demand. That's how the other half are spending on stuff. But what about travel? Our next guest thinks we will see an uptick there too. Joining us now, Amanda Frazier, Forbes Travel Guide, President of Ratings. And Forbes, by the way, just out with the top picks for 2024. Thank you so much for joining us. So what trends are you seeing? How are the high net worth folks spending their money on travel?
Good afternoon. Thank you for having me. A great way to start the weekend. You know, it's been a busy year in travel the last 12 months, and we've got a really busy year ahead. 2024 is predicted to have as much of a boom as 2023. And when it comes to luxury, people are going to continue to pay premium pricing. But the thing that everyone's talking about is that experience had better beat those expectations. So what our list aims to do is kind of cut through that clutter of online opinions. And some of the trends that we're seeing is really frictionless travel. So I think we're going to see a lot of attention paid to properties that are offering that inclusive experience, properties that can give you everything that you need without having to think about additional planning on top of all the planning that it takes to kind of book a trip and obviously get to the destination that you're going to.
And Amanda, one really interesting trend that you called out was how the American South has become so popular with the kind of the luxury consumer and traveler. What exactly is going on there?
We're seeing a lot of activity, some great properties performing at great levels across Nashville and Charleston and New Orleans. There's a Conrad in Nashville that earned a rating. The Hermitage just recently had a renovation that's now finished. That's added to the list. There's a Four Seasons in New Orleans. So the South is really showing a strong performance against luxury standards. And we're also seeing a lot of uptick in domestic travel that gets to those destinations that really started to pick up throughout the pandemic. I think people were looking for easy drive destinations. And when they started to go to those resort locations across the East Coast and across the West Coast, we really started to see that those destinations also paid attention to their infrastructure and really started to invest in more hotels. There's a lot more opening, but also the airports as well. So these are really easy destinations to get to. The South particular having a great location close to Atlanta here.
And then in a very different geographical location, the Mideast is also seeing strong demand, which is particularly interesting right now. Obviously, there is a war going on in the Middle East, Israel, Gaza. So is that affecting demand at all, or are people sort of just circumventing those areas?
It's circumventing. I mean, we're seeing a lot in the Middle East that came out of the results this year. And, we started to see this trend quite early on, actually. As we started to see performance particularly in Dubai. I mean, if you haven't been to Dubai, it's an incredible city. The weather's wonderful. It's clean. The culture's amazing. And we had 20 new additional winners come out of Dubai that got added to the region this year. And the Middle East in general, even with the Waldorf Astoria Kuwait, which is now a double 5-star hotel for its hotel and spa, just doing a fantastic job. And it's really a destination to get to, especially in the winter as well. So I've got a great climate for the winter.
And Amanda, you also have for us here the most Instagrammable hotel, Amanda. Which is it and why?
The most Instagrammable hotel, Instagrammable, that's a hard word to say, right? This is the Waldorf Astoria Pedregal in Los Cabos. So it's in Cabo. It's a fantastic hotel, beautiful destination, amazing staff, and a beautiful leadership team as well that really put their passion behind delivering an upscale experience for their guests.
Amanda, I'm sold. Let's book it. Thank you so much for joining us, Amanda. Have a great weekend.
You're welcome. Thank you for having me.
Time now for what to watch next week. Another huge week for earnings. Coca-Cola, Shopify, Occidental, DraftKings, and Coinbase all reporting, among others. Shopify announcing fourth quarter earnings for 2023. This coming after the e-commerce company reveals a new program where it will buy Meta and Google ads for its sellers.
And speaking of shopping, new retail sales data from the Census Bureau coming out on Thursday. Economists forecasting sales in the U.S. to fall in January. The monthly report giving us some more insight into the health of the economy as markets keep a close eye on the Fed's potential rate cuts.
And moving over to sports, Super Bowl 58 is coming up on Sunday in a matchup against the San Francisco 49ers and the Kansas City Chiefs. Taylor Swift is grabbing a lot of the headlines going into Sunday, but sports betting is poised to have its biggest day ever in terms of Americans placing wagers and how much money is on the line.
we know your money's going to be on your 49ers.
I'm Bay Area native, and I will be betting, Julie. That's true.
Will you?
Yeah,
I will
I
not
will.
be betting, and I'm generally agnostic on the topic
That's
entirely.
okay. That's
But
okay.
happy
You're
Sunday
excited
to
for
you.
me. That's what
I am
counts.
excited for
Yeah, I
you.
know.
It's
Thank
very
you.
true. All right, that'll do it for today's Yahoo Finance Live. Be sure to come back Monday at 3 p.m. Eastern. You got to be back here, even if you watch that big game, and we'll give you all your coverage leading up to and after the closing bell.